Ms. Foo Miha.
Mr. Deputy Speaker, the proposed Significant Infrastructure Government Loan Act, SINGA, represents a significant shift in the government's position on borrowings for the purpose of government spending. I support the bill. It is coming at a time when the country is facing another hump in its development spending needs, with plans for new rail lines, water and sewerage infrastructure, as well as coastal protection measures against rising sea levels. These important projects come amidst a tighter fiscal situation exacerbated by the COVID-19 pandemic. The proposed SINGA will enable the government to continue investing in nationally significant infrastructure, which incur heavy upfront cost but provide long-term benefits. With a low interest rate environment and Singapore AAA credit rating, the borrowing cost associated with SINGA is expected to be low. SINGA will make related amendments to the Financial Procedure Act to provide for capitalization of the expenditure of these nationally significant infrastructure over the long term. This is in contrast to the current approach of fully expensing off upfront in the annual budget of government. Sir, the ability to capitalize expenditure under SINGA will enable lumpy upfront costs to be spread out across current and future generations who will enjoy these benefits. It will help free up cash for other needs, lessen pressure for tax increases, and trade-off on competing important investments. So I have 3 questions for the Minister to clarify relating to capitalization. 1, for the Minister to provide details on how far out capitalization of projects under SINGA will be allowed. 2, quantify the fiscal space created from this new accounting treatment. 3, estimate the amount of taxes that would have had to be raised to fund such long-term expenditures if these were made under the current annual expense approach. Sir, even as I support this bill, we must exercise utmost discipline in what we borrow for and the extent of our borrowing. I would like to call out the need to guard against going down the slippery slope of other countries where public debt has been accumulated to higher than that of their GDP, thereby transferring immense tax burdens from today onto future generations. High levels of government debt can have adverse effect on the economy, including crowding out private sector investment, creating the expectation of future tax increases, and injecting overall uncertainty into the economy. It is critical that SINGA does not represent a material shift from the government's long-held policy stance of maintaining fiscal prudence. We must ensure that our net asset position remains strong to absorb the borrowings under SINGA. The debt we accumulate must not put unfair pressure on future generations. So to avoid the temptation of a spend, spend, spend mentality that access to easy money can engender, it is critical that the government puts in place the necessary safeguards. It is important that we establish a set of robust parameters at the starting line. Now, borrowings must be carefully calibrated, and we must draw a red line that should never be crossed. Mr. Speaker, I'm therefore confident that clear provisions are provided in the bill to separate major infrastructure from routine infrastructure and recurrent spending. Projects under SINGA need to be at least 4 billion, with the infrastructure available for use for at least 50 years, owned by the government and important to national interests. I call on the government to put in place a Singer evaluation panel to include independent expert panels to ensure all projects funded under Singer are highly selective, robustly assessed against the qualifying criteria provided under the bill. There should be also cost-benefit analysis to justify the expenditure. It is important that our borrowings are sustainable and prudent. The bill includes safeguards that cap the overall gross borrowing at $90 billion. However, statutory boards such as HDB, LTA, PUB have also issued bonds on financial markets to finance infrastructure projects. How do we ensure that the cumulative bond issuance, whether for Singer or non-Singer projects, by all government agencies as well as contingent liabilities, remain within acceptable range? Borrowings under Singer are capped at $90 billion, about 20% of today's GDP. I would like to ask the Minister, will this limit be adjusted as GDP grows? How will the government ensure Singapore's AAA credit rating be preserved amidst increased borrowings? Sir, the bill provides for an annual interest threshold of $5 billion to avoid imposing burdensome financial costs on future generations. Nevertheless, the potential interest cost of $5 billion on our annual budget is still very significant. To put things into perspective, the impending GST hike of 2 percentage points is expected to raise $3 billion in revenue. But GST would have to be raised by 3.3% to cover interest costs of $5 billion. This does not include the additional revenue needed to also fund annual depreciation of the capital expenditure borrowed under Singer. Of course, having said this, given the current low interest rate environment in the foreseeable future, I do agree with Honourable Member Liang Ying Hua that it makes sense to tap the debt market now. But we must remember interest rate will rise, can rise. So this bill does provide some buffer for interest rate cycles use and the potential for issuance of longer tenure bonds. Mr. Speaker, the government's intention to issue green bonds under Singer is a great move. For a start, up to $19 billion in public sector green projects have been identified to be financed by green bonds, including the waste and water treatment facility at Tuas Nexus. Singer has the potential to catalyze the flow of capital towards sustainable development, not just in Singapore, but in Asia. I have seen a strong momentum amongst investors around the world towards environmental, social and governance ESG causes, with increasing numbers of asset owners making commitments to prioritize sustainability and investing for good in their investment portfolio. Therefore, the green bonds under Singer are therefore likely to be well supported by market demand, attract more favorable pricing, and have potential to deepen market liquidity for green bonds. Last but not least, I would like to end by seeking a number of clarifications from the Minister in relation to the assets under Singer. With the expectation that the infrastructure should be available for use for at least 50 years, thus $90 billion limit takes into account upgrading and maintenance costs over the lifespan of the infrastructure. If not, where in the budget does it provide for this cost? 2, if interest rate rise and the cost of debt servicing hit the threshold, does the government have the right to divest the government-owned assets in part or fully to keep within the interest rate threshold? The government can raise money outside of Singapore and in a currency other than Sing dollars. How does the government intend to manage the foreign exchange risk related to this borrowing?